Today, we're going to be focusing on what is a credit score. Oftentimes, there's a little bit of confusion about what actually is a credit score, how is it developed, and how is it made. In addition to that, why do I have so many different types of credit scores? What goes into a credit score, and how do I build an overall healthy credit score? So, we're going to be covering a lot of information today. My goal is to keep this relatively short. I know that everybody has things that they need to get back to. But let's jump into this as a few more people continue to join us here. The first thing that we felt like it would be important to discuss is what actually is a credit score. Uh, when it comes to your credit score, it is a simple way to identify your risk as a consumer based upon the information that is listed on your credit profile. So what does that mean? Essentially, if you were to look at your credit report and you were to look at all of the information that's on your credit report, what is on there is being broken down into what we call factor codes. And these factor codes are then pushed through an algorithm that gives you a simple scoring tool that you can identify your risk or that person's risk as a consumer. And these credit scores are used in a variety of different industries. But when it comes to credit scores, the difficult part about credit scores is that they're very black and white. They don't tell the full story about why people have credit challenges or why they have the specific credit score that they do. I think a lot of people can sympathize where, there are certain life events that happen, whether it be job loss, divorce, medical emergency, whatever it might be, that can hinder your credit score, but your credit score doesn't necessarily reflect the challenges that were associated with that life event. And that's why credit scoring can be fairly cold, because it is very black and white. But essentially, your credit score is a tool to simply identify your risk as a consumer. And what a lot of people kind of struggle with when it comes to credit scoring is, why do I have so many of them? Right now, it feels like you can go to your local credit union, you can go to your bank, you can go to Credit Karma, you can go to all of these different places, and you have a variety of different credit scores. And it's becoming very difficult to understand what is a healthy credit score, what is a qualifying credit score. Why is my credit score a 680 on Credit Karma, but yet when I go talk to my mortgage professional, it's 620? These are a lot of questions that people deal with. And the simple answer to this is that there are several providers of credit scoring models out there. And we need to talk and give a little bit of a history lesson here. So the credit scoring world was mostly dominated by one company for a very long time. But over the course of the last 20 years, you've seen a lot of competition in credit scoring. And credit scoring has become very popular because it is used in so many different ways. You have credit scores that are associated with insurance and retailers and even employment. There are a variety of different credit scores out there, and credit scoring has become very competitive. And so now you're seeing credit scores on your credit card app, from your Credit Karma app. You're seeing them at your local bank. You have your mortgage professionals that use certain credit scores. And I wanted to kind of help debunk some of the myths and the questions that are associated on, why do I have so many different credit scores? And in order to kind of break that down, we need to talk specifically about two companies that provide credit scores. The first company and the most popular company is FICO. I'm sure a lot of you have heard of this company before. This is that company that controlled the market. FICO was established in 1956 by two engineers who identified a need in the marketplace, because during that time, credit and access to credit was growing dramatically. And if you were to take your credit report without a credit score and go give it to your mortgage professional or to a banking professional and say, hey, can you tell me what I qualify for? They're going to have a really difficult time identifying your risk, because they would have to go through every single line item and be able to understand whether or not that's a healthy credit line item, an unhealthy credit line item. And they would have to use their own personal opinion to give you some type of identifier based upon what your risk is. And FICO was able to take all of the information that's on a credit report, put it into what we call factor codes, push it through a unique algorithm, and create a very simple score that identified your risk as a consumer. Now, FICO, like I said, they were the king of credit scoring. In fact, most credit scores in the market still today are FICO related. When it comes to your mortgage, we're going to talk a little bit about that and specifically what credit scores are used, but FICO dominates the mortgage market when it comes to credit scoring. But FICO's biggest competitor is what we call the Vantage score. And the Vantage score was created in 2006. I'm sure a lot of you remember the catchy little jingle of the freecreditreport.com. It's kind of burned into everybody's brain. But this was a really important year because this credit score was designed to help people who are credit invisible get access to credit. Credit invisible consumers are people who have a lack of credit history, either because they don't have enough credit history to get access to credit, or things have happened on their credit profile that keep their credit scores low. Now, the Vantage score, the thing that's really important about the Vantage score is that it's become very popular among consumer monitoring sites and consumer lending. And so when you open up your Credit Karma app or when you open up your Smart Credit app, the credit score that you're most likely to see is a Vantage credit score. And that Vantage credit score varies dramatically compared to the FICO credit score that you would see, for example, if you were to apply with a mortgage professional. And so I want to kind of help break down the differences between the two and give you really clear information about what exactly goes into your credit score. Because as you're working to build healthy credit, as you're working to reach your credit goals, as you're working to optimize credit so it's no longer a burden, so it's something that's actually saving you money and creating opportunities for you, it's important to know the rules of the game to have healthy credit. And so I'm sure that you've seen pie charts similar to this in the past, but what actually goes into a FICO credit score? So there are 200 individual factors that go into a credit score, and all they give us is a pie chart, which unfortunately, isn't really that fair. So I'm going to do my best to explain this. When it comes to your credit score, the first thing that's calculated is your payment history. This is very similar to most of the advice that we get when we're young from our parents. Pay your accounts on time and you'll have a good credit score. Well, 35% of your credit score is based off of that advice, just paying your accounts on time. And being able to pay your accounts on time is a really big deal because not only will it help you establish credit history, but it shows that you have a healthy relationship with credit. You know when your payment dates are, you take accountability for those, you know how it's going to impact your credit score. So knowing that, paying your accounts on time could impact your credit score by up to 35% is vital to having a healthy credit score. Now, the second thing here is amounts owed, which makes up 30% of your credit score. Now, what they're talking about here is how you use credit cards and how you use revolving lines of credit. A lot of people misunderstand how big of an impact it can have on your credit score if you don't have a healthy relationship with credit cards. And so one thing that we recommend, and it's on your credit snapshot when you sign up for our services, and it's part of the advice that we provide for our clients, is keeping a low credit card balance, preferably below 30% of the available credit limit, to really help you optimize your credit score. If you are paying your credit cards off every month, that's not a bad thing. That is helping you progress to build a healthy relationship with credit cards. But remember, if you carry high credit card balances month to month, it could have an impact of up to 30% on your credit score, which could really hinder your ability to get access to credit and keep your credit score low. Now, the third thing that they're talking about here is length of credit history. This is essentially just having an established credit profile from a young age. Now, there is no minimum age requirement to have a credit profile established with the credit bureaus. However, most companies who provide loans or give you access to credit do have minimum age requirements. But having a length of credit history that is beyond just 6 months or a year is important to maintaining a healthy credit profile. Now, something that we get asked a lot about are authorized user accounts and joint accounts on credit cards and things like that. And we can talk a little bit more about that. But what's important here to remember is that credit is a pay-to-play system. So if you don't have credit or if you don't use credit, you're not going to have a credit score. And so it's really important to understand that establishing credit early and using it correctly, keeping low credit card payment or credit card balances and making your payments on time is crucial to building a healthy credit profile. And having a solid length of credit history is about 10% of your credit score. The next one is new accounts. And what we're talking about here is specifically inquiries. Inquiries are unique because you have two types of inquiries. You have soft inquiries and you have hard inquiries. Soft inquiries do not negatively impact your credit score, whereas hard inquiries can. And so if you are aggressively looking for credit, if you're going out and you're applying for store cars and auto loans and mortgages and credit cards and all of these different types of credit accounts, if you look for credit too often, so for example, if you're applying more than 12 times for credit in a year, that could potentially negatively impact your credit score. And if you are aggressively looking for credit too often, it could negatively impact your credit score by up to 10%, which is a big chunk that could be taken out of your overall credit score and holding you back from credit qualifying. So the advice that we give with inquiries is be cautious. If you don't need it, don't apply for it. Now, if you are trying to rebuild your credit, inquiries are going to be an unfortunate necessity, because as you're trying to rebuild your credit score, oftentimes you have to start by establishing new accounts. And so make sure that you're doing your research on the types of accounts that you're establishing. If you're looking to establish an auto loan or you're looking to establish a credit card, make sure that you're getting the right rate, that you're getting the best offer that's available to you, and it's the right thing for your unique financial profile. But know that inquiries are a part of life. However, if you aggressively look for credit and you have too many inquiries, it could potentially negatively impact your credit score. And the next one up is types of used credit. And this is something that I get a lot of questions about from our clients who are trying to build a healthy credit profile long after they utilize our services and long after they've been able to either purchase their home or reach their credit goal. And this is one that oftentimes comes up, which is if you're trying to establish a healthy base of credit, usually you want to have different types of credit accounts. So what this means is that the credit or that FICO wants to see you using at least 2 revolving lines of credit, an installment loan, and a mortgage. That's usually the perfect mix of credit. However, if you have only credit cards or only auto loans or only personal installment loans or only a mortgage, that could negatively impact your credit score by up to 15%. And so having a healthy mix of credit accounts, again, a revolving credit line or 2 revolving credit lines, an installment loan that could be open or paid, just showing that you had an installment loan that you pay on. And then in addition to that, a mortgage or other types of accounts. This is going to optimize your credit score to help you maintain a healthy credit score for the long term. This is information that can be found on our website as well if you have additional questions on this, or you can feel free to reach out to our team members here at Premier Credit, and we'd love to answer more questions regarding what goes into your credit score. But these are the 5 key factors that go into your FICO-based credit score. And it's really important to know the rules of the game so that long after you've been able to accomplish your credit goals, that you can continue to optimize your credit to save money and create new opportunities for you in the future. Now, when it comes to your Vantage score, why is my Vantage score so much different than a FICO score? Why is my Credit Karma credit score way different than the credit score that my mortgage lender is giving me? These are important differences that we need to identify so that you don't get caught up in this really complicated trap of, well, my Credit Karma app says this, my Smart Credit says this, my mortgage lender says this. We want to help kind of clarify this for you so you don't get stuck in that trap. So a Vantage credit score, usually seen on Credit Karma or Smart Credit or other credit monitoring sites, they use alternative data when it comes to calculating your credit score. Excuse me. An example of this is rental payment history, utility payment history, and other types of non-traditional credit types are calculated into their score to help provide a credit score for people who have a lack of credit history. So this is a key difference between a Vantage credit score and what you're going to see with a mortgage professional when they pull your credit. In addition to this, the algorithm is different at weighting certain categories. So the actual algorithm itself uses a different scale for how each aspect of credit impacts your credit score. And then this is a little bit more of a not that big of a deal, but it's important to mention that they use a tri-bureau model that creates a higher level of accuracy, meaning that the same scoring model is used with each credit bureau compared to FICO, where each credit bureau uses a different version of a FICO credit score. So these are the key differentiators between a Vantage score and a FICO credit score. And that's why you see such a big variance between your credit monitoring app, whether it's Smart Credit or whether it's Credit Karma, and what your mortgage professional is going to provide in their specific credit scores. So moving on here, what score matters when I'm trying to buy a home? If you're trying to get ready to credit qualify for a home, you're going to see 3 different scoring models used. Experian uses a FICO score 2, Equifax uses a FICO score 5, and TransUnion uses a FICO score 4. So essentially what this means is that even if you have the same information across all 3 credit bureaus, all of the information is the same, you're still going to have 3 separate credit scores because each individual credit bureau uses a different credit score. And so this is important to help kind of answer those questions of, well, why is my TransUnion a 650 or a 700 and my Equifax is a 680 or a 660? It's because each credit bureau is using a different credit scoring model to identify your risk as a consumer. So moving on to the next one here, which is, what is a healthy credit score? A healthy credit score is one that will help you save money and get access to credit regardless of the credit scoring model that is being used by a lender. If you look at a lot of the information that we post as a company on our blog or on our social media pages, what you're going to identify is that we don't hyper focus on credit scores. We focus on helping people build a healthy credit profile. And the reason is because a lot of different lenders, whether you're looking for an auto loan or a credit card, whether you're trying to buy a house, whether you're trying to buy a couch, whatever it might be, they're all going to use different variations of credit scores. And if you have a healthy credit profile, it shouldn't matter which credit score is used because you'll be able to get access to credit and have a really good interest rate to save money. That's our goal here at Premier Credit, is to help people establish healthy credit. And so in order to do so, we have some tips for building a healthy credit profile. The first one, I touched on it earlier, managing your credit card balances. This is vitally important because this is going to help you not only increase your credit score, but maintain a healthy credit score for the long term. And again, maintaining a healthy credit score not only is going to help you buy a house, but it's going to impact how much you pay on interest for an auto loan or a credit card. It's going to help you create opportunities to save money. Even your insurance is impacted by your credit score. So learning how to have a healthy relationship with credit cards and keeping your credit card balances low is important for building and maintaining a healthy credit profile. The second thing is accuracy. Having a credit monitoring site or having access to your credit report on a monthly basis is critical because you want to make sure that the information on your credit report is fair and accurate, which is your right per the Fair Credit Reporting Act. And then in addition to that, making sure that the information on your credit report is positive. If you have derogatory items on your credit report, such as collections or charge-offs or derogatory accounts or late payments, working to get those items resolved and potentially removed while building positive, healthy credit is not only going to help you quickly increase your credit score and reach your goal, but it's going to give you the opportunity to maintain healthy credit. And so if you can keep your credit card balances low, if you can watch your credit report and monitor that on a regular basis, and be vigilant and aggressive about trying to resolve derogatory accounts on your credit report, those are going to be the 3 biggest factors when it comes to building and maintaining healthy credit for the long term. So we've covered a lot of information today. My goal was to do a short webinar, so I didn't take up too much of people's time, but to provide information on what goes into your credit score, how does it work, what are the key players when it comes to credit with FICO and the Vantage score, how do credit scores work, and what you can do to continue to build healthy credit. I wanted to personally thank all of you for not only trusting our services, but taking time out of your day. And I wanted to remind you as well that if you're looking to save money on your services with Premier Credit, referring a friend or a family member for a free credit evaluation could save you $25 on your next month's bill. But most importantly, we have an abundance of free resources on our website. And so if you ever have questions, I recommend that you check out our blog, our podcasts. We have videos on YouTube. We have a lot of information out there to help you as you continue down your journey of building healthy credit. But I wanted to also encourage that if you have questions or if there's anything more that my team here at Premier Credit can be doing for you, please don't hesitate to reach out to us because We want to make sure that you have a great experience, that you reach your credit scoring goals as quickly as possible. So thank you so much for taking time out of your day. I hope that this was valuable for you. We'll be releasing more of these webinars on a monthly basis moving forward, and have a wonderful weekend. Thank you again.